In an optimized economic system, capital acts like oxygen. It circulates freely across every layer of the market, ensuring that productivity and innovation are continuously funded from the ground up. Within Islamic finance, this philosophical imperative is codified as maqasid al-sharia. It dictates that wealth must actively circulate through real economic activity, and it strictly prohibits the hoarding of capital among a narrow elite. But observe the reality of modern capital concentration. The vast majority of global liquidity is pooled at the top, leaving the lower levels of the economy completely disconnected from the financial grid. An economic framework explicitly designed to distribute wealth is currently failing to execute its own foundational philosophy. To understand why, we have to look at how the plumbing of the system was actually built. For decades, the traditional Islamic money and capital market has relied on massive institutional tools to raise funds. The primary mechanisms are instruments like sukuk, Islamic bonds. These act as rigid, high-volume financial pipelines designed for governments, conglomerates, and massive infrastructure projects. Issuing a sukuk requires expensive underwriting fees, deep collateral, and strict commercial banking audits. This creates a structural bottleneck. The system effectively filters out anyone without an established corporate pedigree and massive asset reserves. It successfully creates high liquidity and financial stability for the market, but it restricts that liquidity entirely to those who are already wealthy. Legacy banking structures, by their very design, contradict the mandate of distributed wealth. At the ground level, the effects of this bottleneck are severe for micro, small, and medium enterprises, or MSMEs. Because they lack decades of credit history and heavy collateral, MSMEs are systematically rejected by traditional Islamic commercial banks. They are locked out of the capital markets. In developing nations like Malaysia, MSMEs are the primary drivers of employment and GDP growth. Starving them of working capital stalls the entire national economy. The structural correction to this drought has arrived via financial technology. Digital platforms are introducing two profit-driven alternative models: equity crowdfunding and P2P, or peer-to-peer financing. By utilizing web algorithms to bypass conventional banking intermediaries entirely, these platforms return the market to its first principles. Equity crowdfunding and P2P lending function as the primary engines of alternative financing. Instead of relying on a bank to pool and deploy capital, these platforms act as a digital switchboard, directly connecting investors with underserved entrepreneurs. Cutting out the banking layer slashes underwriting costs and removes rigid credit barriers that block smaller firms. This digital disintermediation executes maqasid al-sharia at scale. It forces capital to flow horizontally across the market, rather than pooling vertically at the top. Each platform serves a distinct economic function. Equity crowdfunding, or ECF, is designed to raise long-term equity for early-stage startups. To remain halal, ECF relies heavily on profit and loss-sharing contracts. The most common is mudaraba. Mudaraba separates roles. Investors provide capital, while the entrepreneur contributes labor and expertise. Alternatively, musharaka is a shared risk contract where all parties contribute both capital and effort. In either structure, returns are generated strictly through corporate dividends and share appreciation, with no guaranteed payouts. If the firm loses money, the investor absorbs the financial loss. Tying returns directly to actual corporate performance structurally prevents the predatory debt traps often found in conventional venture financing. While ECF secures long-term equity, P2P lending solves a different problem: managing day-to-day cash flow for existing businesses. Offering direct cash loans with interest rates, riba, is strictly banned in Islamic finance. Money cannot simply be rented out to make more money. Instead, Islamic P2P financing structures these transactions through tangible economic goods, primarily using an asset-based commercial contract called murabaha, which is a cost-plus profit sale. Consider a practical scenario. A small halal food manufacturing firm urgently needs capital to source raw ingredients to fulfill a new order. Step 1. Retail investors pool capital on a digital P2P platform. Step 2 is critical. The platform acts as an agent, using pooled funds to purchase raw materials directly from a supplier, bypassing cash loans. Finally, Step 3. The platform sells materials back to the manufacturing firm at a pre-agreed cost-plus profit price, paid over time. Structuring debt entirely around the movement of tangible economic goods ensures that wealth circulates within the real economy, preventing the destructive commodification of money itself. To maintain this standard, Malaysia regulates these digital platforms through a highly specific framework, classifying them as recognized market operators rather than licensed banks. They operate under dual oversight. The Securities Commission Malaysia monitors market behavior and enforces operator guidelines, while Bank Negara Malaysia maintains broad financial stability and cybersecurity protocols. To enforce Sharia governance, every platform operator is legally mandated to appoint qualified, independent Sharia advisors. These advisors audit the financing structures to prevent elements like gharar, ambiguity, or deception in a contract. They ensure that compliance is a substantive economic reality, not just a contractual label. Between 2020 and 2025, regulated ECF and P2P platforms in Malaysia successfully raised 11.5 billion ringgit, directly financing over 20,000 businesses. Theoretical Sharia principles become safe, investable realities when backed by strict regulatory architecture. Despite this growth, the medium to long-term evolution of Islamic alternative finance faces critical operational bottlenecks. Retail investors often lack the financial literacy to accurately assess the default risks and illiquidity associated with early-stage companies, creating severe information asymmetry. Operationally, P2P lending platforms suffer from immense friction. Assessing credit risk for unbanked MSMEs requires massive amounts of manual processing time. Compounding this is the intensive human labor required to conduct ongoing Sharia compliance audits across the entire lifecycle of thousands of micro-investments. If these platforms remain isolated, manually operated digital spaces, the sector will inevitably hit a hard ceiling on growth. Artificial intelligence provides the functional upgrade needed to solve these manual bottlenecks. Predictive AI analytics can ingest alternative datasets to instantaneously evaluate the complex risk profiles of MSMEs that lack conventional credit records. Furthermore, smart algorithms can replace slow, human-driven verification to run continuous, automated Sharia monitoring. They can audit transactions in real time to ensure operations remain entirely free of prohibited elements. By substituting manual audits with automated software, platforms drastically reduce administrative overhead while maximizing operational transparency for the retail investor. The final structural shift required to achieve scale is a market dynamic known as co-opetition. It is a misconception that digital fintech platforms will fully displace traditional Islamic banks. Commercial Islamic banks operate under strictly regulated capital buffers. This makes them naturally risk-averse, and they will continue to reject early-stage enterprise applications. The future is a hybrid framework. Institutional banks can integrate digital P2P structures as secondary investment vehicles, using them as deal origination pipelines. Through white-label partnerships, banks can safely co-invest alongside retail investors on crowdfunding platforms. This bridges the SME financing gap, while allowing banks to diversify their asset portfolios within regulatory limits. When tech-driven efficiency is fueled by established institutional capital, the circulation of wealth moves from a localized pilot into a systemic mechanism for funding the micro-enterprises that define the broader market. This is the structural fulfillment of Maqasid al-Sharia.